Hey, what's going on, everybody? Welcome back to the Land Development Podcast. I'm your host, Ryan Glick. And if this is your first time joining us, each week when you tune in, you're going to hear one of two different types of shows. Sometimes when you tune in, you will hear an interview style show where we have on someone associated with the land development industry. We hear more about their origin story and how they got into real estate. And then we also talk about some of the projects that they have going on. Other times when you tune in, like today, we have industry news. That's where we pull up three different headlines and we talk about what it means to our industry. And as always, joining me on these industry news episodes is Charles Covey. Charles, thanks for joining me.
Hey.
All right. Well, we waited a little bit longer to record this one because we wanted to hear what the official news is or was from the Fed. Instead of recording this when we normally would record it, we pushed it back just so that way we could hear what the Fed had to say. So that's going to be a big part of what we talk about here today once we get into our articles, and excited to dive into these topics.
Yep. It's going to be good. We got a lot of stuff happening this week.
We do. And it's nice that this topic, we can have a little bit of closure on this, like at least the one decision that we've been kind of building up to. And now obviously a lot can happen from here, but
Right.
It's nice to actually be able to talk about what happened versus what could happen.
Right.
All right. Well, let's go ahead and pull up the articles here. So first article is coming to us from CNBC. The headline reads, Fed slashes interest rates by 0.5 point, an aggressive start to its first easing campaign in 4 years. And actually for this article, we're going to be watching, if you're watching, a video from CNBC reporting on this. And if you're listening, you'll get to hear the audio to that. So let's go ahead and listen to this, and then we will be reacting.
Range of 4 3/4 to 5%. There was one dissent, Fed Governor Michelle Bowman preferring to cut by 25, but 11 voting in favor of 50. It might have been close. I'll come back to that at the end of this report. The statement says the committee will consider additional adjustments to policy based on the data, the outlook, and the balance of risks. The summary of economic projections saying an additional 50 is expected or forecast by the median Fed member for this year, for a total of 100 this year. That would bring the median down to 4.4%, or an additional 50 basis points from where we are right now. Another 100 basis points of cuts expected through next year, bringing the rate down to 3.4%. All of that a bit above where the market is priced. And the new long run rate would hit 2.9%. That's up a tick by the year 2026. The statement now says the Fed is firmly committed to supporting both maximum employment and the 2% inflation target. Before and for many months before this, the Fed had relied solely on saying it was focused on the inflation target. The committee has gained greater confidence, the statement said, that inflation is moving to that 2% target, and risks to both sides of the mandate now are said to be roughly in balance. On the economic description, the economies continue to expand, it says, at a solid pace. Job gains, however, have slowed. Inflation making further progress towards 2%, but remains elevated. It's seen declining to 2.3% this year, 2.1% next year, and hitting the target 2% by 2026. Unemployment, the outlook for unemployment did tick up. I think that's important to what the Fed said here and what it did. Up 0.4 to 4.4%, 2 ticks higher than it is right now. Growth pegged at 2%, slightly above the 1.8 potential, well into 2027. Now, 9 officials in the dot plot wanted to do 75 basis points or less this year, and 10 wanted to do 100 or more. So it may have been a very close call as to what was actually wanted around the table in terms of 25 or 50 today, but they decided ultimately with 11 voting in favor of the 50 basis point rate cut. Tyler.
All right. So I think we've been talking about this for a while, and, I know you've thrown it out there, whether, speculating on whether it was going to be 25 basis points or 50 basis points. And it seemed like based on, the votes that all but one had, 50 basis points, the one dissenting view that came out that wanted 25 basis points. I'm not sure if you're surprised by this or what your thoughts are on where this ended up going.
Yeah, this was what I was expecting, just based on what I had, not because I have some, great ability to predict, but just based on the majority of what I was reading, it seemed like that was the largest consensus, and the market had pretty much expected 50% or 50 points. So I think that because of that, There's obviously it's funny to watch this. Everybody has their opinion and they want to give their opinion on the media. So you have to be cautious. Like everybody everybody they have to give viewers somehow, and so there's all these opinions today of well, the Fed's wrong or the Fed's right, and I a lot of it is just to get views, and so I'm just kind of cautious there. I'm following the information of a few people that I trust that I think are actually good economists and actually putting good information out. I think what's interesting to me is if you look at the old data of previous times that they've done a half a point rate cut, and in those previous times, there's been a pretty significant downtrend in the stock market and a recession to follow. At least it looks like it followed. What I think is that it was already happening, and the rate reduction was just trying to combat that. I don't know if this is exactly the same scenario. Obviously, 2008 is a very different scenario. 2020, different scenario. I'm just looking at this chart. These are different underlying factors. So I would like to think that the soft landing is happening, but I've been saying for a long time that that never does quite pan out. So it's going to be a really fascinating few months to see how does the market do here. The factors point to a recessionary environment. I think that's clear. But recession means a lot of things. When some people hear recession, they think, "Oh my God, it's 2008. Everything's going to crap." But that's not the case here. We don't have those factors. So it can be, it could be 5% of that or 10% of that recession. So recession is it means a certain thing, but it doesn't mean everything falls apart. So I think we want to just be very cautious with which talking heads we're listening to over the next couple of weeks, as everybody has an opinion.
Yeah, and I guess as I was reading different articles and also watching some different some of the footage from just thoughts from like some of the talking heads and everything, I kept hearing that there's a lot of different thought around our like how the economy is going to, or how people are going to react to it, and just the timeline of certain things happening. And it seemed like the consensus is that with the rate cut, you're not necessarily going to see something immediate as far
Right.
as a change in, say the real estate industry or anything like that. It's something that it's a trickle down. So it's going to take some time. And obviously if they're going to be making additional cuts this year, I mean, that also in turn is going to have an impact at some point in the future. But it's not like rate cuts happen and then all of a sudden, boom, everything's back to, or the way we want it to be or anything like that. So I thought that was interesting.
Yeah. To your point, the majority of the residential mortgage has already priced in this amount. So, and those were priced in last week. So today it didn't have a big change. So we're not going to see, oh my gosh, residential mortgages drop dramatically today. That's not really the case because the expectation was priced in, and for the most part. On the commercial side, we're definitely going to see costs come down. Half a percent maybe isn't enough for a ton of projects to all of a sudden make sense, but it means a little bit, and every little bit helps. So projects that were kind of on the cusp, maybe they weren't quite hitting that yield on cost or whatever the metric was. Now maybe they're going to take a second look, and it might be more interesting. I think more than the actual numbers, there is just the general feeling, and let's not pretend that most of the markets that we operate in, whether it's a stock market or a real estate market or going to the grocery store, there's a lot of emotional buying that happens in any of those markets. And so I think the emotional element here is that it's better than the last 2 years if we're looking ahead. And the last 2 years were challenging in real estate. And I think this will free up the mental state of a lot of the dry powder that's sitting. And I think the number that I saw, that there's something along the lines, I made some notes here, 324 billion in dry powder that's sitting on the sidelines, specifically earmarked for real estate. And we'll talk about a couple of other asset classes in a minute where some of that money is going to go, but a bunch of that's going to go into projects that have just been sitting. And so you've got the challenge of, okay, the interest rate was higher, so maybe the project didn't pencil as well, but also it's just harder to get equity, harder to get capital moving. And on the debt side, it's just been challenging because those lenders are just a little more tentative at the moment. And I think some of that tentative nature will start to free up a little bit. So again, goes back to just kind of how everything will start to move a little bit more. And the rate is just a big factor in the mental approach that people take to it.
Yeah, when I was just looking ahead, I was just pulling up the calendar here for the Fed schedule. So it looks like the next meeting is November 6, 7, and then December meeting is December 17 and 18. So
Right.
we will see in the coming months like what they're going to be looking to do again. But we're also obviously going to be tracking along with how the market is reacting and how things are going. We're still in the middle of the election season too. So there's just a lot of moving parts going on right now that can have a potential impact on not only the economy and markets, but also buyer behavior. And we're actually going to touch on something related to buyer behavior in the next article once we get to that.
Right.
All right. Anything else you want to add on this?
There's so much. It's like,
Yeah.
how do we pare down this and keep it in a reasonable amount of time? Like we could go 20, 30 minutes on this topic easily. And I've got tons of notes here, things that I wanted to cover, but I think we're going to have to see it play out to the point that you said earlier. Nothing dramatic happens overnight. So it's just going to be a gradual thing of sentiment is the word that I was looking for earlier. Sentiment is improving, that will play out. But you've got the conflict of sentiment towards the real estate market and the interest rate, coupled with the election and that kind of what that does to sentiment and kind of everybody just sitting tight. So my guess is that we'll start to see the majority of the reaction / action to this and the next two reductions, which I'm assuming probably be a quarter point the next two meetings. So now we've got a full point reduction start in January, at least the way that it went this year. Everybody gets back from their vacations and their ski trips and whatever else. And about the beginning of the second week in January, everybody wakes up and says, oh my God, I've got money that needs to be working. And I think that that's probably what's going to happen this year. The election is a contributor. I think January, February, March is going to be the term is assholes and elbows. Just everything's going to be going. Just stuff's happening like crazy. That's my guess. We'll see how that plays out.
Awesome. All right, well, let's jump into the next article here. This one comes to us from Market Watch. The headline reads, "Jittery home buyers want the election to be over before they make their move. Nobody knows what's going to happen." So reading from this article, fall is traditionally a slower time for home sales, but this year buyers seem extra wary. Uncertainty over the presidential election, questions over the direction of the U.S. economy, and confusion about new rules for home buying brought on by the National Association of Realtors legal settlement have some buyers hitting the brakes on what could potentially be the biggest purchase they will ever make. Not to mention the possibility of a Federal Reserve interest rate cut on the horizon, which we obviously just discussed. So this article came out before the announcement from the Fed. All right, continuing on in this article, applications for mortgages fell in August to the lowest level since last October when mortgage rates neared 8%. The decline in applications was puzzling given that it followed a sharp drop in rates. Thomas Ryan, an economist focused on North America at Capital Economics, wrote in a note. Even though the winner of the presidential election has no direct and immediate impact on the housing market, some buyers say they're waiting to see how the election goes before making home buying moves. Some buyers say they'll only buy a home if their candidate wins, Matthew Purdy, a Colorado-based real estate agent, said in a Redfin blog post. Others are waiting because they feel the economy and housing market are shaky and hope it will improve after the election. All right. So as we mentioned in the last article that we were going through, obviously we don't know, what the interest rate reduction is going to do to buyer behavior, but there are a lot of other factors in play. And so I thought this article was interesting just from the standpoint of there's a lot of reasons why people are going to be sitting on the sideline and not making a move. And just because interest rate changes are going to happen, I don't think there should be an expectation that consumers are immediately going to go out and make some changes. We've heard from both candidates and what their stance is, or at least what their platform is on, related to housing and everything. And they have two different approaches to it, but they're both, doing things to address, how, their personal, stance or their platform stance on how they're going to address housing. But I think, it's kind of funny because in this article they say it doesn't really matter which president is going to be elected, it's going to impact this. But then in the very next sentence, it talks about how some buyers say they'll only buy a home if their candidate wins, which is also a very strange outlook to have just in general on life, that life stops if your candidate doesn't win, apparently. But yeah, anyway, I don't know what your thoughts are on this.
Yeah, that quote, that they'll only buy a home if their candidate wins, that really stuck out to me because first of all, I think it's ridiculous. And I don't think it's true. I don't think the data doesn't tell us that is how things actually play out.
Right.
It does tell us, though, that we're in a very divisive time, so divisive that people would say they might not even upgrade their life and buy a new home just because they're pissed off about which candidate won. I mean, that's a pretty divisive time if our politics are really causing things to operate that way. So that was surprising to me. But I think we can probably all agree that's not how it'll actually play out. People still want the things they want, and they still want to spend money on the things they want. They want to feel the way they want to feel. They want to live in a new home, regardless of what happens. And as we also know, and I can speak from experience having worked in DC, nothing happens fast there. So regardless of the outcome, I'll double down on this one that I said earlier. I think January, February is going to be a lot of stuff happening. And I think the beginning of 25 is going to be really fun in a lot of ways. I don't think it's going to matter that much in the near term who wins the election. Now, there are long-term effects, and over the 4 years of that term, there could be some pretty impactful things done. But in the near term, January, February, I don't think it matters. They're not going to be able to do anything that fast anyway. So we'll see how that plays out.
Yeah, I definitely like where your head's at, with respect to timelines of starting to see certain things changing. And it does feel like if we do see a quarter and a quarter to get us to a full point by end of year, heading into next year, we're going to be past the election, like you said. We're going to be, after a full point rate cut. And so we should start to see, mortgage rates go down even further, by that point. And so it feels like we should start to see people moving. I don't think we need that, like we talked about before. I don't think we need that more demand side incentives to get people moving. I think people already want homes, and they're just kind of waiting for the right time, and an adjustment in the rate, will make for first time home buyers it more likely that they can actually afford a home, an entry level home. So it's going to make a difference for some of those people getting into their first homes.
Yep.
All right, well, let's move on to the third and final headline here. This one comes to us from Globe Street. The headline reads, "Why Private Capital is Voraciously Buying Up Office Assets." Reading from this article, without question, the office sector has been the most challenging commercial asset class following the pandemic. Since 2021, office asset values have fallen 40%. And the office market is responsible for 41% of the value distress in commercial real estate. And yet some investors are seeing a silver lining. Private capital, namely private equity firms, family offices, and other non-institutional capital syndicates, are actively pursuing deals in the office sector, according to Karen Witt, 2024 Crew Network president and president of Colliers U.S. Real Estate Management Services. This class of investors is seeing an opportunity to purchase assets at a discount in primary geographic markets that have followed a historical pattern of recovery after a market dislocation. Attractive pricing is driving private capital to the office sector. Today, investors can find properties discounted 50 to 75% from their previous transaction, according to Witt. Of course, these properties have a high vacancy rate and much different fundamentals than pre-pandemic. Still, the discount is providing an opportunity to drive value. As cash buyers, they can undercut the market to some extent with their lower acquisition cost, allowing them to attract tenants who are seeking value or lower rents, explains Witt. These owners can be aggressive in pursuing leases as they have capital for tenant improvements and commissions to increase occupancy and thus property value. When it comes to location, investors are sticking to the classics. They are targeting primary locations in central business districts over suburban or smaller markets. Although CBD office has been hit the hardest by remote work and migration outside of urban environments, they've been known to recover following economic dislocations. CBDs with a history of recovering in business cycles are strong bets, says Witt, adding that investors are looking at markets with strong demographic trends and the potential for business growth. On the other hand, geographies that have struggled with high vacancies in the past cycles are not ideal candidates for a distressed office acquisition strategy. And the last one here, in addition to location, investors are also looking at asset quality. High quality assets struggling with tenancy and income due to the market shift are providing the best opportunity for investors to generate value. Older buildings or those in need of capital infusion are much more difficult to pencil. Revitalization of dated buildings can only go so far, said Witt. With significant construction and releasing costs, it really questions whether the asset is worth reinvestment. It's kind of a long one there, but the reason this one really stood out to me, aside from wanting to get into or talk about some other asset classes besides, residential, single family residential, is the fact that I believe just the beginning of this week, we heard that, Amazon came out and said that they are requiring their full, everybody to come back into the office.
Mm-hmm.
And that's a pretty significant move. And, there's been a lot of backlash from the workforce related to that. But we've talked on the show many times about there's going to be some sort of shift back, whether it's a hybrid or something in the middle from where we've been over the last few years, because I think these businesses are starting to realize that you can't have the same, just the work environment's not the same when you're 100% remote. You don't have the same company culture. You don't have the same work ethic by everybody. Not everybody is capable of holding themselves accountable in that type of setting. But yet when companies are 100% remote and everybody's working remotely, these employees for companies are not providing the value they're supposed to be providing for the pay that they're receiving. And so this article here, kind of showed me that, hey, maybe there's going to be something here. I don't know to what level we're going to see people going back into the office, but I do think, even me right now, as we're sitting here talking, I primarily work out of a home office, but I come into an office, to work on occasion because I can perform, better in an office setting. And I think a lot of people that's true for a lot of people. And so I do think office is going to come back. I just don't know what level it's going to come back. And, at the whole topic of this particular article being related to some of these, like you talked about early on with some of that money sitting on the sideline, this appears to be one of those spots where they're betting on, some of these locations where businesses are going to be going back to office at some point, and they're just buying these assets for a much lower rate.
Yeah. So the factors here, it's definitely a group of haves and have-nots as far as which office assets are even interesting. So even if it's not a deal, like if we're just talking about which areas are interesting, and there are stuff that even if it was free, you couldn't give it away. So there are some office assets that are literally useless, worth zero. They're worth the dirt they're on. So you can demo and they're worth the dirt, but outside of that, very little value. However, like they're talking about, well-located, well-placed assets still have value. So what we're seeing is there's one that I just read about that was in California, and they bought it 20 years ago, paid X for it. I don't remember the exact numbers, but it was a $60 million delta in what they bought it for 20 years ago and what they sold it for now. So wow. They held it for 20 years and lost 60 million. It's like, that sucks.
Yeah.
And this is a very notable firm. Like this is not idiots, but it didn't work out well because the occupancy's not there. Couldn't get anything for it. So now somebody's going to come in and buy it at that $60 million discount from the bank. And now it might actually pencil. Maybe they can reduce rates at such a point because of that value difference that it makes sense. Or maybe they'll do some partial conversion or something. I am seeing some deals come across that are pretty high yielding deals where we're able to go in and get an office building for dirt cheap and do a residential conversion. A lot of these are tough though, but a few of them do work. And in the ones that are really well located, and they can get premium rents, those deals scream and the returns are really, really nice. So a lot of that money that's sitting idle, it's been sitting idle, some of it for a couple of years, waiting on these deals, and so they're starting to flow now, and there are some, but there's not $324 billion worth of these distressed deals. There's maybe 150. Yeah, my guess is that there's 150 billion top end, maybe less, maybe less than 100 billion. So there are some deals to be had, but still that doesn't explain what that other delta of dollars is going to do. It's going to have to go to work. And so I think we're going to see a lot of that flow back into the traditional real estate areas. So the developments, the kind of things that we do, flowing back into debt and equity lending on horizontal development for home subdivisions, all these kind of things. So yeah, there are deals to be had. Office sector's fascinating. I'm absolutely just enthralled by watching this happen. I mean, you watch somebody sell a building at a $60 million discount after 20 years. That's wild. I mean, it's just wrapping your mind around that. It's crazy. I would be so pissed.
To say the least. Yes.
Yeah.
Yeah. I wonder what's going to happen to all of those more distressed, office spaces that people don't want. Like, are they going to are we going to get to a spot eventually where they're going to basically just be used for the land that they're on and repurpose or build something that's more attractive that people are actually going to want? And that's assuming the location of them is good. I mean, if the location's not good, you can't, there's nothing you can do about the location if the area around it is not appealing to people,
Right.
potentially there.
Well, there's been a few things proposed, and it's very nuanced, right? So I'm thinking of some areas in Dallas. Some people have proposed, some of these really challenging high-rise scenarios to put jails in them, because jails don't require windows on every cell, right? So that kind of large floor plate problem that we've talked about before with the residential conversion, trying to get windows in the bedrooms and keep light in the unit, that gives you kind of a dead area in the internal part. But you can do jails and other things in those, and so I think high-rise jails will actually see a few of those happen. Conversion cost is super expensive though, so it's challenging. You can go buy cheap dirt in a rural area and build a sprawling jail complex pretty economically. Tough to replicate that in a high-rise scenario. Just the costs just go through the roof. So we'll see it happen a little bit. It's the ones that I think are most interesting to me are the suburban office complex. You got like a 2, 3, 4-story office, bunch of surface parking, kind of big sprawling area, nothing else around it except other office. And what the hell happens to those?
Yeah.
Like maybe there's some data center conversion stuff. There's a few that I've seen where they're going in. A lot of them have a lot of surface parking, and you can take that surface parking, and if it's well enough located, then you can go in, you redevelop, you put in parking garages, you go vertical with your parking. Now you do, you do some apartments, you do maybe some single family, or you do some commercial or some other, creating a multi-use site. And some of those will work. There's a few of those that are happening in Dallas I think are really, really good and done really well. So there are some opportunities there. But when that doesn't work, some of these are just going to sit, and they're literally going to crumble because it's going to be too expensive to demo the thing. And it's not going to make sense. Some of these you can go, within a mile and buy dirt that hasn't been developed. So why would you overpay for dirt that you got to then go do, then you got to go do the demo on. So then you'd have to buy the dirt at a discount. So I think some of these are they're trash really, which is crazy.
Yeah. Well, we will see what happens here in the coming weeks. We'll come to you guys again here in a couple of weeks with our next industry news episode. We'll kind of see what the very short term reaction has been to the market and everything as we get roughly about a month out from the election and what's going to be happening there and everything. Any closing thoughts from you, Charles, before we call the show, bring it to a close?
Yeah, as I've been saying the last number of weeks, it sounds repetitive, but I'm so enthralled with the time that we're living in and all the stuff that's going on. I think we'll look back on these days as pretty pivotal for our country and for the real estate industry. And so I'm just paying a lot of attention because I think this is a really special time, and it's got some challenges and it's got some kind of craziness going on. And I think we're going to look back on this time with some fondness because it's going to be really impactful to the next 20, 30, 40 years. So it's an exciting time to be in this business.
Awesome. Well, I think one thing I'll add is that I've received several messages. As we continue to do the show, I get messages from people who listen in. A lot of times, just on LinkedIn, I'll connect with people, and they'll send me messages and thoughts and everything. And we have quite a few younger in terms of new to the industry who listen into the show, and so I think it's really cool for them to be able to hear both sides of, to be able to hear from people who talk about their story coming into the industry, but also being able to understand how the industry news and everything plays into decision making and how you analyze some of this. And so I think it's really cool to be able to hear how you approach a lot of this as someone, who's been in the industry for a while. And so anyway, for those of you who are listening in and everything, definitely, reach out if you have any thoughts on any other topics you want us to cover, even any guests you want us to have on at some point in the future. Send them my way, and be happy to try to line those up and try to provide as much value on the show as we can. I mean, that's the whole purpose of why we're doing this. So again, thanks for listening as always, and we will talk to you next week.